Hey miners, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome Tyler Page. He's the CEO of Cipher Mining to the channel. This is actually Tyler's first visit on the program, so we've got a lot to go through in today's presentation, including a recap of their recently reported earnings, an update on their Black Pearl site and construction, and their outlook on the HPC front. Now we're going to go through all of that in today's video. Before we do though, please take a second, smash the like button guys. It's a big help to myself and the channel. Anthony absolutely loves it. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comments section below if you're currently holding shares of Cipher, what you thought about today's conversation, and your outlook for the back half of this year. Now with that being said, let's get into today's interview. Okay, guys, so that's right. For the first time ever, we've got Tyler Page, CEO of Cipher Mining, on the channel to join us. We're going to be talking earnings, but because it's Tyler's inaugural visit, we're also going to be forwarding some subscriber questions and learning quite a bit more about Cipher Mining in today's presentation. So Tyler, I know we got to meet down in Nashville. It was a real pleasure talking to you down there. It's great to have you on the channel and representing Cipher. Welcome to the program. Thanks for making the time.
Yeah, thank you so much for having me, and thanks for all the coverage you guys give the industry, Bryce and Anthony. I know lots of people listen to the podcast. I know I do, and so excited to be here for the first time.
In the office for the first time. We'll get right into it. We wanted to ask you first and foremost, because it's your first time on the program, can you give us a little bit of information about yourself, how you got involved with Bitcoin in general, and then more specifically Cipher?
Sure. I've done a lot of things in my career and bounced around, and I've ended up, for a long time now in Bitcoin. I actually started my career as an attorney, and then for a few years in New York, and then worked on a series of derivatives desks at some big investment banks for the first, half-ish of my career. And then moved more to the asset management side of things, kind of the hedge fund world, working in New York and London. And had a personal interest in Bitcoin starting in, I think it was early 2014. It was right after Mt. Gox collapsed. People that I know kind of in the trading world had followed Bitcoin, and it was a little fringe, and so I knew of it, but I didn't take it that seriously. And personally, I got involved right after Mt. Gox collapsed, and it didn't go to zero. I actually thought, like, wow, if like basically the entire market place collapses for an asset and it doesn't go to zero, it sure must have staying power. So I took it more seriously. Then professionally, I started working in the space in 2017. I was working at an asset manager called Stone Ridge Asset Management, and we started working on a crypto business there, which launched, and people know it now as NYDIG, or the New York Digital Investment Group. So I was there in the sort of test kitchen before there was a NYDIG, and then part of the management committee and original team that launched that business and really built the whole go-to-market strategy there. That's a little more downstream from mining. That's more, although I guess they've gotten into it after I left, but that was more of an asset management, custody, trading, that sort of thing, business. And it really sparked my curiosity. I got to meet with a lot of very large institutional investors, sovereign wealth funds, big pensions, et cetera, at the very early end of trying to talk about Bitcoin. 2017, 2018, 2019, I was flying all over the world saying, look, this is kind of a retail asset, but if you have a super long time horizon, it actually makes more sense maybe to be in a sovereign wealth fund or something like that. It was early days. I'm not sure there were tons of buyers then, but I was pretty positive. I left that firm at the end of 2019 and then really went down the rabbit hole on mining. And the thing that was really interesting to me about mining is that the economics and the way the business is set up, it looks a lot like commodities production, basically, but it's really early stage, like new commodities. So I tell people it's a little bit like, think about, drilling for oil and refining it, but not today, but like in 1890 or something like that. Like the car hasn't even been invented to buy all the oil for gasoline and things like that. And so I think, in 2020, I started working with a firm that'd been around in the space a long time called Bitfury. They were trying to figure out, um, they had kind of a US opportunity set they were trying to figure out, and they're Europe based. And a lot of their mining was in places like Kazakhstan and places that Georgia, like Tbilisi, not Atlanta. Um, and they were trying to figure out how to capitalize on this opportunity in the US, and they hired me to do that as a consultant. And then it turned out there was a lot of enthusiasm in late 2020, you'll remember, for mining and taking off and Bitcoin taking off. And so we made this decision to sort of completely split off the US opportunity, make it an independent company, and take it public as a greenfield company. So, technically I am the founder of that business. They provided the capital and some of like the letters of intent for contracts and things like that, and took an equity stake in that business in exchange. And then I hired a great team, and off we went. And so that's kind of quick story of getting into Bitcoin, and haven't been able to sleep for a long time because need to wake up in the middle of the night and check prices and things like that for a while now.
Yeah, super interesting to hear that origin story, Tyler. And like most people we talk to on the channel, I think everyone wishes they took Bitcoin a little bit more seriously at the start. But the Mt. Gox specific incident, you're exactly right. If they can take down the entire exchange system at that point in time and the underlying asset holds value, I think there's definitely something there. So appreciate you sharing that. Now, the next question we wanted to ask, fast forward a couple of years here. You just came out with earnings. So Cipher obviously has a lot going on. We want to get some construction updates, but we are curious to hear some of your high level or highlights from earnings here.
Yeah, so I mean, look, this quarter for everyone had the halving, and so that's the major impact on thinking about things. And I talked about this on our earnings call. Um, there's a couple ways to think about that. Obviously, the revenue is down across the industry as is expected and planned for. And I think the longer we stretch out with low hash price being paid to miners, um, the more miners need to make a decision about how they're going to tackle that and get their hash cost down. We already have very low hash costs on a relative basis, mostly driven by our very low cost of power that I'm sure we'll get more into. But the real highlight of this earnings call was talking about the tremendous amount of growth that we have planned. Like, the other way to lower your hash cost is grow very effectively, get more efficient machines, produce more Bitcoin, and then your cost per terahash and cost per Bitcoin goes down because the rest of the business scales. This has really always been part of our plan. Our hash cost recently was about $43 in cash terms, and only 19 of that is power, the electricity bill itself. The rest is overhead, SG&A, things like that, which I view as really an investment in the business. So we're building, we're talking about getting to 13.5 exahash by year end with just an upgrade of our Odessa site, and then getting to 35 exahash next year with a very efficient fleet when we build our new Black Pearl site. The rest of the business is already really built to accommodate that. So we get tremendous leverage and scale just by doing the upgraded Odessa this year. Looking at the numbers, we would expect to get our hash cost below 30. And so that looks really good, obviously, when you scale up with and that's just a more efficient fleet, more top line hash rate. So a lot of this quarter's earnings were about growth plans. So building out Odessa this year, constructing Black Pearl, which is a 300 megawatt data center that will be Bitcoin mining next year. And then the other big announcement is a series of site acquisitions that we're in the process of finalizing. Specifically, we have 1.7 gigawatts of sites that we are in the process of getting into the boat, that we've signed paperwork on, and we expect to close in the coming weeks. That's across 4 data centers. The first one we expect to energize in early 2027. It's currently approved for 70 megawatts, but we think it can get to 200 in terms of approved capacity based on discussions we've had. The other three sites are earlier development phases, but we found an ability to identify really good sites earlier in the process, and it's sort of 3 by 500, 500 megawatts each are what we're seeking at the sites. So it's really this growth story, and that gets into the launch of an HPC infrastructure business I'm sure we'll talk about. That's really the focus of the quarter. Just looking at the numbers, as expected, I still think we shook out pretty well. As expected, things like revenue were down because of the halving. But if you look at our overall numbers on a GAAP basis, we had about a $15 million loss on a GAAP basis. We've adopted the FASB rules for marking to market our inventory. I think we had about a $16 million loss just on the inventory of Bitcoin. So, I'm very positive that our business is extraordinarily resilient in the quarter that is going to be a little ugly, and maybe we'll get another one or two here. Our numbers still look very strong from my perspective, especially with all that growth coming up. So that's really what we're focused on now, is this sort of like, you've got to look at what a miner's hash cost is and how they can manage it. And I think the obvious way is people say, well, strip out some costs. You can do that, but we're really still an early stage growth and development company. We're hoping to be operating gigawatts of sites in the coming years, and that's the side that we're focused on to drive those efficiencies to a better place.
So for clarification purposes, Odessa at the moment, it's a case of replacing some of the less efficient miners with more efficient miners to grow hash rate and reduce that efficiency, which in your update suggests it's going down to 18.6 by the end of this year, which it's going to be one of the most efficient fleets currently by the end of the year. I mean, we talked about miners now getting into that 22 zone, but this is a lower than 20 zone, and it looks like some of the big miners are with the amount of orders they've got in replacing. Because I think people forget you've got to replace miners as well. It's not a case of buying big orders to grow hash rate. You've still got, we talked only 3 years ago, everyone was talking about S19s, and now really those are the ones that are now having to be effectively replaced with the latest models. So in terms of that there. So, and obviously with the growth next year with the Black Pearl site, it's going to be, can you give us an indication of the types of machines going into that site there? Also, are you still going to be able to get the level of power that you're operating at Odessa at the moment in Black Pearl site? And just give us a bit more color onto that particular project for next year.
Sure. So one piece at a time. So I think, and you guys have to do this all the time, right? These companies trade on like a forward anticipated basis, as you know. And so in my mind, and this will frame probably a lot of the discussion we have today, but I think about how do you minimize the risks to those projections? Everyone's got rosy projections. Before I even got into Bitcoin mining, everyone knew some guy with a gigawatt of power, that story's been around for a while. So the question becomes, I think, for any investor or analyst, what's the kind of discounting that we put on that storytelling? So for us, the growth this year and the efficiency this year is really straightforward. It's swapping machines at Odessa, which runs very well. The orders are from Bitmain and Canaan. The plan for Odessa, to answer your question on models, is we've got Bitmain S21 Pros en route there, as well as some Canaan A1566s. And it's really just a swap and replace that gets that both top line hash rate up to 13.5 and the efficiency down to 18.6. So I view that as like, it's not done yet, and there's always risks, and Bitmain's got to ship the machines and all those sorts of things. But that's pretty low risk, in my opinion. Like the site's already running, the machines have to show up, we need to plug them in. And at that point, you'll be pumping, the lowest cost of power in the industry, at least for the public miners at scale, through maybe the most efficient or among the most efficient fleets, because everyone will be upgrading. and with 13.5 exahash. So that 13.5 exahash will punch above its weight. Then when you get into Black Pearl, so Black Pearl is a 300 megawatt data center. This is an enormous structure in West Texas. Foundations have been laid for the building, or I should say the beginning of the building. Steel is being erected now. In any given day, there might be hundreds of people out there that often show up to the site at like 1 in the morning to work when it's not so hot in West Texas. And the machines that will ultimately end up there that we've got under contract are Bitmain S21 XPs. So what will be the most efficient machines next year, short of some new breakthrough that I know also sometimes gets promised, and also XP Hydros. That's what's envisioned. So we have an option on that. And then the other, that's about roughly half-ish of the site. The other half, we have, again, an option agreement on Canaan for their next-gen machine, which will be coming out after the 1566s, which are out this fall. We've had a great working relationship with Canaan. I know we're one of their biggest customers. Their machines do very well in the heat down in Texas. And, you know, like all the big manufacturers, we try to keep a pretty close relationship with them. So they don't have specific specs, but there's kind of a framework of specs that will be best in class within an awesome acquisition price. So that's what's planned to go in there. And the forecast, which again, as you get further out, forecasts need to have more error bars on them, but we're forecasting 35 exahash top line with a fleet efficiency of about 15.3 joules per terahash. Some of that will depend on exactly where the efficiency of their next gen chip shakes out, et cetera. We have a fair amount of flexibility there.
And from a cost of power perspective, where do you see the blended price?
Yeah, sorry. Right. So Black Pearl is a front of the meter site. Maybe it makes sense because I haven't been on before, and I know you guys sometimes talk, and I think people ask questions about our power and is that real? And is very real. So we have 4 sites currently. I'll run through the names. I know when I sometimes watch your show, I can't remember everyone's site, but we have one really big site that's about 86% of our production recently, and that's Odessa. It's 207 megawatts. That has a behind-the-meter fixed price PPA. We've got about 3 years left on that fixed price PPA. Without giving the specific price on that contract, given that it's 86% of our operations, you can guess that it's pretty close to that portfolio average of 2.7 cents.
Yeah.
And we publish pretty extensively in our quarterly deck, which is available on our website, what we've paid per Bitcoin and power cost year to date, what we paid at each site, what we paid post-halving. We try to be very transparent on that. We tend not to give numbers per Bitcoin across all costs, although I'm happy to share them with you today on a backwards-looking basis. I don't like giving them on a forward-looking basis because basically, number one, they're always wrong. And then number two, I try to steer people towards the all-in cost of electricity because that's the thing you can't change. There's a lot of elements, even on the cash side, which can be kind of accounting and flexible. So for example, we will typically pay people year-end bonuses if they have a great year. If the year went sideways, we accrue for that throughout the year. You could decide, oh, prices are down a lot, don't pay it, and you strip that cost out. You can't strip out the power cost. And so like when you think about low-cost provider for a commodities producer that is a Bitcoin miner, that's the number we think you should. All the other numbers are super important to evaluate different things, but that's the number that's like, how resilient and sustainable is this business? And so that's what we highlight. So behind the meter, very close to the portfolio average, 86% of the portfolio. The other 3 sites that we currently operate are in joint ventures with a partner, the same partner. We own 49% of each JV. So it rounds to 50-50, but from an accounting perspective, they're the majority owner, which I know, Anthony, makes you happy because we just have one line item. We just have one line item on our financials, but we do share information about the sites in our quarterlies. So, I mean, it gets reported in the geography of financial statements. It gets summarized. and it is only 14% of our production and going to go down as we expand this year and next year. But that said, happy to talk about the power across those sites. So one of the sites is 40 megawatts. It's connected to a wind farm. It has a behind the meter PPA, is our cheapest power in the portfolio. So without giving specifics, it is cheaper than the portfolio average. I've said that in the past. And it is under a PPA at a fixed price. Okay. So those are kind of the anchors on the fixed price side, behind the meter PPAs, heavily negotiated, heavily structured, time the cycle, good time to fix your price. We did all those things a couple of years ago. We have a great team. Then you look at our other two sites we currently operate, Bear and Chief.
Hey, Tyler,
they are both in.
Sorry to interrupt you. I just wanted to ask, I know it's a smaller component of the overall portfolio, but is the PPA at the wind farm site about a 3-year expiration as well, or?
No, yeah, about 3 years left on the initial, but it's got options to renew. So,
sure.
Yeah. So it is fixed for the foreseeable future at that very cheap price. And again, it's drawing directly from like windmill power there, which is why it's so cheap. We're located next to the farm. So where was I? So Bear and Chief are what are called front of the meter sites. So they pay the floating price for power in those areas in Texas. Now, the big thing with this is that we run them actually just like we've codified the contract at Odessa. The reason why the price is so cheap at Odessa is that we've traded a 5% curtailment option to the power provider. So in Texas, what happens is prices stay really, really, really low most of the time, and then they can explode upward. Yesterday was a hot summer day in Texas. There were $1,000 a megawatt hour prices down there yesterday. These are times when we would not want to pay, a floating price because you would want to curtail. We basically pre-sold that curtailment to the provider, and in exchange for that, locked in that super cheap price the other 95% of the time. So we're trying to run Odessa 95% of the time. We will never run at 100% uptime because we've literally sold 5% back to the provider. If you look at the front of the meter, so the floating price data centers, we basically replicate that. If you chop off the 5% of time that is the most expensive in Texas, this moves around and is seasonal and will be different quarter to quarter, but currently it'd be about 3.5 cents a megawatt hour if you did it really well. Now that's before you get into selling capacity, the right to curtail your data center to the grid operator. There's all kinds of other things that folks do down in Texas, ancillary services, et cetera, that can then even net out lower. And we do some power sales at Odessa, not in that 5% of the time, but there are other times when we can make more money pulling the power back to the grid rather than using it to mine. And we will also be opportunistic with that. So now I promise I get to answer your question. So that's kind of the setup of our sites now. Yep. And that averages out to about 2.7 cents across the portfolio now. Black Pearl is in Texas. It is front of the meter. So it will run like Bear and Chief. Again, today, if you ask me, if we cut off the 5% of expensive times, which we've got a whole tech and operating stack and that basically does that automatically based on price signals, I would expect it to be about 3.5 cents with some seasonality and moving around. The other thing is that with such a large data center, it will be eligible to do things like participate in those demand response ancillary services programs. And I'm not giving any credit to the ability to net out revenues we can make on that. So truthfully, I hope we will drive that price on a net basis even lower and maybe even in line with where we are today.
That's a similar observation that Jason's talks about with the Corsicana site. I think part of that reasoning is really the fact that to try and get a PPA in today's market is a challenge. In terms of getting those PPAs that you've got already in place there, because they're done so long ago, energy was far more in a different position, and you're able to get cheap energy PPAs there. The Rockdale facility, which I've got theirs is really cheap there as well, and so. But you've articulated exactly what Jason said. There are real opportunities with the market rate, actually, by curtailing, by doing everything sensibly that way, and getting a sort of like they're hoping exactly for the same as you, 3.5, and that's their sort of like um, you know, pessimistic position. They think it'll be even less than that, but they're putting that out there saying, no, it's going to be about 3.5 cents. That's good. I did want to pick up, you mentioned there about having, dealing with a number of suppliers, which is really interesting because generally some of the miners have these relationships with one of the miners. It could be Bitmain, it could be MicroBT, or, and it sounds like you're one of the biggest customers to Canaan. Do you get the opportunity to test their models before you start making significant orders, so you know what you're sort of getting into? And I know that you don't want to give the specs away in terms of what Canaan do now, but I mean, from what I've seen from Canaan, they're a little bit behind where Bitmain are at the moment in terms of efficiency. But do you see? Are they telling you that they're going to get to those levels in the not too distant future?
Yeah, so a couple things I can give you. So we ordered A1566s for Odessa. Those are an efficiency of about 18 and a half
Yeah.
joules. So it's, a little bit behind, best in class, like the S21 Pros, I think are closer to 15. That said, like, I think Bitmain has generally led the field in efficiency, but without meaning to say anything negative about Bitmain, often their machines run into like any new ASIC. Sometimes there are challenges when a new machine comes out, and it takes a while to get used to it. So we do try to test everything we get. The Canaans, they invented the ASIC chip, so like I'm perfectly confident that they will continue to improve. Whether or not they're absolutely like bleeding edge of efficiency, I hope they are. We also get a pretty fantastic rate that we pay them. Suffice it to say, they're the cheapest machines we buy. We do take advantage of our position with them, in the sense that they have been very supportive with very good deals because they've wanted to work with Cipher as well. And Anthony, look, we try to test everything. We have a dialogue with all these startups and the new entrants and people marketing the next great machine. In the test kitchen, we've got hydro and immersion and new rack designs, and we do everything a little bit in the skunk works. But at scale, I mean, we want to stay diversified with really good providers.
And that's a good point. I mean, we talked about the big three, the suppliers there, but even in the mining space in the last 12 months, we've seen effectively three new entrants. We've seen Auradine, we've seen Block, and we've also seen, which I think is probably the best name in mining, the Seal Miner from Bitdeer. And that's not too much of a surprise, being the fact that Bitdeer were originally part of the Bitmain company. So are you sort of mindful of these new people coming into the market and what they can bring? Because I think even Bitdeer's first generation miner is probably about the same efficiency level as the Canaan model that you've just quoted there.
Yeah, absolutely. I mean, like I said, we try to have a dialogue with everyone. I would say we probably have a little bit of a higher bar to commit to a big order with a new name, because sort of the differences between testing a chip and taping it out and mass producing the chip and then getting it into a miner, like a rig that is mass produced. There are many steps along that path where things get lost. And every bull market, there's new entrants, and most of them fade away or fail to tape out or whatever. So excited, would love to have relationships with 10 providers, and some of those names have a lot of pedigree, and so that's why we talk to them. Probably starting from a position of, from a big commitment standpoint, like to see just a little bit of progress on the kind of mass production side of things before we commit to a large order.
Hey, Tyler, just to follow up on Anthony's question there, we also noticed at the Black Pearl site, within that 300 megawatts, you've allocated 250 to air cool and 50 to liquid cool. I recall you said you have option agreements on those miners. So are you going to still kind of decide which way you go, or why did you decide to to have one of each version in the same location? Are there benefits to that strategy? Can you give us some color there?
Yeah, absolutely. I'll give you a framework, and there's no set answer to this. So I think everyone's design decision comes down to like how much more does it cost in capex, and then how much does it save you in opex or production. So there's no one answer to these questions, right? Some things cost more up front with the hope that they last longer and have better production numbers. um, we have been fans of air cooling in general because even in hot Texas, keep in mind when it's super hot, there's a lot of correlation when with those times. They are often at times that we would curtail anyway, because that's when the power prices would be highest. Um, and so building a very efficient air cooled design does minimize your capex. If you look at our existing sites, they're containerized data centers. Um, what you can save in capex is often, from an ROI perspective, worthwhile, even though it might not be the most cutting edge engineering experiment as far as driving efficiency. And look, I tell people all the time on our team, I think immersion and hydro, super cool. I love looking at the displays at conferences, like, wow, that's amazing. Those hash boards are dunked. From a corporate decision making perspective, we tend to be kind of very disciplined on like, what does the spreadsheet say in terms of how much money we're going to make on this? We don't do things just because they're cool. So I think when we look at Black Pearl, there is this desire, I think, to broaden our experimentation and innovation a little bit more beyond just air cooled. We know we can manage air cooled and manage the associated curtailment, underclocking, optimization, et cetera. We know the machines and how to operate them pretty well with air, and that is a lower capex spend. That said, lots of innovation is happening in the space, and this is where data center innovation is converging a bit with Bitcoin mining. And Bitcoin mining is kind of like the scrappy, cheaper end of the spectrum as opposed to HPC. But things like, liquid cooled, direct to chip cooling, et cetera, that's kind of cutting edge on the HPC side. And so there's an element of, we've been testing designs for a long time. We wanted to do something with decent scale to basically prove this out. We think we've got a hydro solution that we think in the long run will have a higher ROI. A lot of it depends on conditions in Texas. It's hard to say. There's a lot of variables. I'm just very comfortable with what we do know how to engineer, which is why 250 we're planning for air cooled. 50 is substantial. That is not a small amount of hydro. The design at Black Pearl is one building, but it's kind of like 6 50-megawatt wings that are connected. So 50 megawatts is a natural kind of cutoff for it. Also, as we get into HPC, we have investor days. I'd love to get you guys down next time to Odessa, or if we do it at Black Pearl in the future, get you guys out there. We've had a couple where we host investors, and we show really well. And as we get into the HPC business, we're hosting more and more kind of reviews of what we're currently doing. We would like to have a pretty cutting edge, innovative hydro piece that we're operating to demonstrate what our team is capable of. And frankly, efficiencies from Bitcoin mining that may map and you may transport over to HPC.
No, that's a good point. Just to go, I want to just go back to the earnings. You highlighted it there with regards to the JV, and the fact that it's under that sort of like the magic 50% cutoff point. So therefore, you can't show all the sort of like the makeup of that line. Is there a way you could actually sort of like provide a little bit of color on sort of like the costs and various other the revenues from that particular JV in terms of how it compares to the rest of the business?
Yeah. So again, power costs, Alborz is going to be the cheapest. It's also going to have the least amount of uptime because quite literally, if the wind's not blowing, the machines aren't hashing. But that's worthwhile in terms of the trade-off. You trade that uptime for such a cheap power cost. When it gets all sort of pulled up into a single line item, one of the challenges is that that's a gap number. So it includes like depreciation and amortization. So I can also tell you, Alborz was our first site we rolled out. It has the machines that we paid the absolute most Cipher ever paid for. I'm still very proud that this is cheap relative to what other miners paid on an absolute term, although it sounds funny today. We did pay $65 a terahash for some machines at Alborz. So a lot of that is depreciation and amortization of a bigger number because that's what was paid and that's what flows through there. Generally, the power costs are very low. OpEx costs are pretty low. It's in line with, particularly, we just scaled. Bear and Chief were 10 megawatts each. They're now 40 megawatts each. So those numbers will be much more in line, frankly, with the rest of the portfolio. So that may not be wholly satisfactory, Anthony, but like fair to say, higher depreciation and amortization, at least at the beginnings of those sites. Roughly speaking, Alborz was built out completely with S19J Pros, as I recall. So efficiency is going to be 29.5-ish there, joules per terahash. Bear and Chief were just upgraded with some more recent Canaan machines. That'll bring their efficiencies closer to like a 23 and change probably efficiency. And really, it's just the depreciation and amortization sort of rolling up into that one number and other gap charges. We did quote, and we quoted post-halving, because I think that's the number. Again, we're trying to give the numbers that I think investors should focus most upon. We did say in our earnings, post-halving at the JVs, we've paid $28,784 in electricity per Bitcoin. And I'll note this, seasonally, that's going to be higher, right? Because it's in the summer at some front of the meter sites. For reference, you know, at Odessa, post-halving, so only post-halving, we paid $23,563 per Bitcoin in electricity. And those are the kinds of numbers, if you're trying to forecast forward, I think are most important when you look at a miner. I mean, again, reasonable minds can differ, but that's why we report them.
So comparable with some of the other sites, and the costs are only high because of the depreciation factors that have been applied.
That's the biggest.
The
that's
nature
the biggest
of the
factor.
miners. I know. I mean, one of your peer miners has also got a JV, and they've had this criticism in the past, but what they've started to do now is really be a lot more transparent with the JV, show those costs running through, and they come up. They highlight more in their adjusted EBITDA, so people can. Those costs are stripped out then, so you can see what the sort of like net figures are. But I know that we posted the fact that we were doing this interview, and a number of people came to me specifically and said, you know, they had wanted to know more understanding of the JV. So we definitely thought that was a question worth pursuing in there, and also, you know, it gives you guys, you know, the opportunity. I mean, I don't know how many times in your investor calls some of the questions that we're highlighting today come up. And I know I've listened to a number of investor calls from miners, and you know, sometimes it's like, you know, what's your favorite color and what did you have for breakfast? And I'm like, that's not the questions I want to be asking this miner. I want to ask a few more. So, you know, bear with us. We'll get through there. But no, yeah. Thanks for the update and the added color to that question. That's useful there. Thank you.
Hey, and speaking of questions, we've got a few more to get through, Tyler, and I want to leave you time. We've got about 10 minutes, some good time to talk about HPC. So you've alluded to this opportunity a number of times. Your company has a plethora of factors that would make them well suited for HPC, including the sites and energy infrastructure, energy cost. What is your take on HPC? Where do you see this going long term? How do you see the relationship between HPC Bitcoin mining? Can we get your thoughts on that topic?
Sure. I think it's early days. So let me try to be as transparent as I can with what we see as the opportunity. And I think it's important really for you guys and for investors to think about this, that one thing I've noticed is everyone just says AI and sort of lumps it, or HPC, and lumps it into a bucket. And there's different business models. So just different companies are doing different things. And I don't view the opportunity as necessarily interchangeable. One might be way better than the other, but they're different. So I'll highlight what the sort of the version we're doing, which is to say, we would like to build large scale data centers for really big, high quality tenants that would potentially take the whole data center. Yep. If it's a hyperscaler, great. If it's a notch down from a hyperscaler, great. But what we are not doing is, at least now, at least to start, maybe it evolves over time, but to start, we're not buying GPUs and speculating on selling our own compute. Doesn't mean it's a bad business. It's one that I don't think is as adjacent to what Cipher does right now. Today, we have a team, like our entire construction and ops team basically joined us from Google. We've got a Meta veteran in there. We got some other people, Advantage, a few other big names in the space. But we've got a team that has built and operated hyperscaler data centers before. Like they had to learn how to build a Bitcoin mining data center. And they did that on the first 4 we've built, and now the 5th we're building. So we have a great team. We do believe that what's very attractive about the version I'm talking about, where we build the infrastructure for a large tenant that brings its own GPUs and pays us via a long-term lease. It's a business that looks a little bit more like real estate development, right? It's a long-term lease from a hopefully very high quality credit, from a credit perspective, counterparty. And then, like everything else in the world that has a very reliable, high quality stream of payments over a long time, it becomes very financeable. So this is a more expensive business. It requires a lot more CapEx than Bitcoin mining. And so it's really only interesting from our perspective if you've got the site. There's a lot of value on large scale interconnects because all those big clients are looking for large sites. If they can get them, they are more valuable if they're ready sooner. So if they're ready in the next 3 years or so, that is much more valuable than 5 years from now because they can all kind of get in the queue for interconnect to try to get it. So we've got that, particularly with this pipeline of new sites we've got. You're talking about minimum of 4 sites and potentially 1.7 gigawatts available to build out. That's a tremendous amount of power for HPC. So we've got these sites that we're working on finalizing. We've got a team already in place. So this is a big differentiator. I think lots of people see the opportunity, and I'm sure many of our peers will be getting into the space. We don't have to post a list of positions we now need to hire for. Like they're already here. So, anecdotally, I can tell you, like we've sent our team to have an all-day session with a hyperscaler on the technical side to go through all the requirements. We show really well. People are pretty sharp on that side here, I'm happy to say. So then the last piece becomes capital. They're extraordinarily expensive. You would never build this business funding it at the cost of capital from a Bitcoin mining business. Like you would not go sell ATM shares and do what we do. Bitcoin mining, potentially the returns are so high on an unlevered basis, right? That like using an ATM can make sense if you have something good to spend the money on. It can be very valuable to shareholders. At this level of capital, the good news is there's lots of traditional, but like banks will loan you money get to build a site that has a high quality tenant. And based on just the amount of discussions we've had from the investors that provide that capital and the potential high quality tenants, it's still early days, but it seems like there's a very insatiable appetite for sites like the ones we potentially can build and sign a lease for. And when you zoom way out as a shareholder, like why is this interesting? I love Bitcoin mining. I love the returns of Bitcoin mining. I actually think you'll probably make more cash Bitcoin mining the next 2 to 3 years than you will on a high quality HPC lease. That said, those leases are 10 to 15 years, right? And so hash price, as bullish as I might be for the next 2 years, in 12 years from now, pretty sure it's going to be lower than it is now. So if you can get a high quality tenant, that's just a very stable line of income that's very substantial. And it really causes the opportunity for potential expansion, like in the multiples on our revenue on the stock overall. So it's early days. We're having these discussions. Everything is positive. We feel very good about the team, the sites, and the access to capital. And now we've got to deliver on that. So we're being sort of really transparent early on. I will say, one of the things about these sites that lines up with the business is if you're going to build a 5 nines of uptime data center, right? Sort of the hyperscaler wants something that's going to have 99.999% uptime.
Texas. No.
It will take a long time to get all the necessary equipment, particularly the backup generators that are necessary. That's probably 2 years away from a supply chain. So the thing I'd say is anyone getting into this business that I'm talking about, this niche, not selling GPU capacity, not breaking up leases or something like that, but like building from scratch a large data center, people aren't going to be getting revenue from this for a couple of years because they literally can't get the equipment. So this is a long-term business. We're very excited about it. I think it's a huge opportunity, but that's how we see the most value in the space and how we're coming at it.
This is, I mean, you're talking about the core scientific strategy, obviously, because that's the HPC hosting. They've just got ahead of everyone because they've got facilities that they can refurbish at the moment. So they're not having to wait 2-3 years like a lot of other miners who've come out and said, we can do that as well. They're sort of moving that now. They'll start getting revenues from 2025. But yeah, it's interesting to see. Are you not looking at any HPC? Have you not got is it not a 20 megawatt deal at the moment that you're looking at in HPC terms, or are you waiting really for those 3 sites or the 4 sites, 200 and 3 500 megawatt sites before you move into that space?
So again, it's kind of early days. So if I get an interesting call this afternoon, maybe something will change. So I want to give that caveat. But that said, yeah, I mean, we are looking at finding a tenant partner to be very involved with the requirements for their design specs and have them take an entire large site for a long time. And Anthony, to give you a sense, if you're going to build a data center for a hyperscaler, they have a spreadsheet that has 300 requirements from a technical perspective that you have to meet. So this is like a very involved process, which is why, again, the way we're looking at it is we want to do it at large scale at one site with one tenant that's very financeable and creditworthy.
Yeah. Cool. Okay, so that's it. We've probably only got time for one last question, but I did want to touch on this because this is one of the questions that shareholders sort of like look at in terms of, trying to understand, and it's all about stock compensation. We haven't raised it on a number of podcasts with other CEOs. We're talking about, what I'd say is, and we've already articulated, it's still a fairly new industry in its infancy. And so we see these numbers for stock compensation in various mining accounts there every quarter. Can you sort of like just educate people in terms of like what the processes are around how these numbers are determined, what the criteria is for achieving it? I mean, I'm led to believe that the numbers in the quarters are sort of like the worst case scenario. If everything ticks every box, then that's likely to be done. But it's on a scale of how well you get to that figure. And I might be wrong, so please correct me if I am. And sort of like, and what have the shareholders got to be looking forward to while this is going on? So like where are they benefiting in terms of that criteria?
So let me give you the framework with how we do it, because I know this is a popular topic, and it's really important to me. And I think our approach, I think it's somewhat unique. So the way we do it, there are some elements that are common for any public company. Doesn't matter if they're miners or anything, and I can run through that. But I think more importantly, let me start with kind of the philosophy of how this works at Cipher. We have time-based vesting. Every employee in the company receives an element of their compensation in stock. We want to do that because I want to align everyone with shareholders. I want people thinking like shareholders. We want people bought in. They have to earn it over time. So they have to be excellent at their job and continue to be. If they get an award, they get nothing up front. They don't get anything for a year. So we have some 3-year and some 4-year awards, but you basically get, after a year of doing the job, you get 1/3 of what was awarded. After another year, you get the second third. Last year, you get the last piece. This is a tremendous weapon for us to recruit with. We are a growth company. Remember, I gave the context for thinking about hash cost. and scaling up being such a big part of actually driving your costs, your hash cost down. We came public as a greenfield company. I didn't have a company to promise people that was operating. We literally had to build it. So part of the way to entice the amazing team we have, those folks that came from places like Google, was to give them a chance to earn equity in the business over time. And so ours are time-based compared to, I think we have the most onerous time-based requirements in the space. Again, getting nothing up front and not getting it dribbled out throughout months or quarters or whatever. You have to be around to do it. And let me tell you, I give you a tangible example of why this is so important. As we talked about, all these companies trade on sort of a forecast for future development. In our case, I'm telling you, we're going to have 35 exahash when we build Black Pearl. So if you're an investor and you don't like our stock, you probably don't believe me. You believe the risks are too great, we won't deliver, whatever. If you do like our stock, you probably do believe me. We'll deliver that. We look super cheap. My argument would be if I could tell you with certainty in a year and a half, Black Pearl's completely built and we're 35 exahash. We're pumping the cheapest power in the industry through the most efficient or among the most efficient fleets at 35 exahash. How much more valuable would our stock be? A lot, I would argue. That's before you talk about Bitcoin. And we've seen this. Like when we brought Odessa online, I could show you all the pretty pictures of it being almost done and our stock was way down. And then when the hash rate came online, we completely re-rated. We were up over 700% in 2023. And so I view this the same way. So I think to myself, for shareholders, how do I ensure that positive outcome? My biggest risk is if I lost our key people. If our chief construction officer said, hey, you know what? I got a bid from Meta to go build HPC data centers because it's so hot right now. We'd be in a bad spot. That would be tough if we lost this team. From my perspective, I like getting as much stock compensation, frankly, that's within reason in their hands that has to vest years into the future. So I know they will be here to receive those shares when that site is completed. So that's an overall philosophical construct that I think is really important. I think also the way we operate is a little different than other names in the space. Again, we're trading power, we're hedging power, we're managing this curtailment. It's different business. You need different skill sets than people that, and I'm not trying to denigrate anyone, it's just a different model than if you just buy machines and plug them and try to plug them in and run them 100% of the time. It's complicated. So that's kind of the philosophy, which I actually think is more important. That said, Anthony, since the way you asked it was, how do you think about structuring it? Like any public company listed on NASDAQ, we have an independent board committee that is the compensation committee. It's required as a part of governance that they determine things like my compensation, management compensation, overall framework for compensation. And they do that very thoughtfully. They do look at what are standards across the industry. They do speak to third-party consultants to make sure they're in line with what comps would be for what they've structured. And in our case, we've left it basically, there's kind of two flavors of this. You said, you know, what are the requirements to hit to get a certain amount? I have a lot of problems with those. I actually prefer it to be at the discretion of the board and the comp committee, and I'll tell you why. In our space specifically, if management here decided to go to the beach and mess around and do no work all year, and Bitcoin went to $200,000, our stock would go up a lot and we wouldn't have done anything to merit it. So like just saying it, we had great stock performance last year, but it's a factor. It's something to consider. Generally, we push them towards looking at production targets. Did you hit your megawatts? What kind of Bitcoin production did you have? How did that look relative to others? How did you deliver on the other pieces of the business? What was energy trading and hedging like? What was the performance from that? How did it measure up versus what we thought would happen? But generally, it's left at the discretion because I actually think it's too easy to game particular metrics. And so that's our framework. That's how we do it. It's a huge part of our business. The thing that's wonderful about it, too, from a numbers perspective, we scale a lot. We're expecting our hash rate to go up about 400% in the next year and a half. That brings all these numbers down tremendously in context of that production, let alone when we build HPC data centers and have gigawatts of power, it all comes down. But I think right now, from a growth perspective, we're not dissimilar to like an early stage growth company in terms of buying really quality talent with stock-based comp, and we make them earn it.
Yeah, I like to hear that, Tyler. There's actually an airline in Canada, and they do a lot of stock-based compensation for all employees, and their motto is owner's care. And I sure think that rings true in any industry, right? If people have invested interest in the company, they're aligned with shareholder goals. I think it's a real recipe for success. So I appreciate you going through that. That more or less brings us to the end of our questions. I wanted to leave you a minute or two just if you had any closing thoughts, but Anthony and I really appreciate the time. I know I've learned a ton about your business in today's discussion and looking really forward to seeing some of these catalysts as they progress here.
Thanks so much, Bryce. Yeah, I mean, look, again, thank you to both of you for having me. I really appreciate it. And I thank you on behalf of the industry for bringing a lot more attention and scrutiny, frankly, to the names in the space. You know, we welcome it. We're really excited about what we're building. I think the number one thing, and it's kind of echoes what I said on our earnings call, and I'd encourage everyone to go look at that because that's really where we try to manage our messaging out to the public. I can be a little bit more thoughtful than just a podcast sometimes, but we're very excited about the potential for growth. So again, I think there's kind of two philosophies in the environment we're in post-halving where hash price is squeezed and making miners a little uncomfortable. You can try to strip out costs to stay alive, or you can try to drive towards growth and become the big scale player in the space. I think that's where we're positioned. So we're really excited about the growth we've got going on. It starts this year with the upgraded Odessa. It continues through Black Pearl. And then this HPC business, I think we've got all the necessary components to really dominate in the space. But it's early days and really excited to talk more about it. We're right at the cusp. So a lot of exciting things about to happen.
Hey, we'll be here with ears and eyes open, ready to listen to you, Tyler. Appreciate the time, Anthony. Always a pleasure. You guys, if you're still watching the video, smash the like button. Feel free to subscribe. If you have any additional questions for Cipher or the team, let us know in the comment section below. We'll pass those along to Tyler or bring it up in our next conversation. Tyler, again, a pleasure having you on the channel. You're welcome back anytime. We'll talk soon.